Welcome, investors. Today we're diving deep into the world of inflation as we await the release of March's Consumer Price Index, CPI. We're looking at an expected headline inflation rate of 3.4%, a figure propelled by escalating energy costs and a surge in the prices of essential goods and services. But beneath this headline figure, there's a complex tapestry of factors at play. We're seeing the housing and auto markets exerting their influence, while commodities and labor costs are also adding to the mix. It's a lot to take in, and it's going to demand some serious navigation from the Federal Reserve. The big question on everyone's mind is, how will they respond? Will they aim for aggressive rate cuts or opt for a more cautious approach? It's a high-stakes game, and the outcome could have far-reaching effects on the global economy. But what does this mean for the Federal Reserve and its interest rate decisions? Economists from Bank of America and Goldman Sachs anticipate a slight moderation in core inflation, citing factors such as housing and auto market dynamics. Indeed, the housing market has seen some cooling off recently, with a slight decrease in home prices, which may contribute to a tempering of inflationary pressures. Similarly, the auto market has seen some stabilization after the supply chain disruptions caused by the pandemic. Experts also highlight the importance of other factors, such as the labor market and wage growth. Strong job growth and steady wage increases can potentially offset inflationary pressures, providing a more stable economic environment. However, there's also the looming question of the Federal Reserve's response to these developments. Will they maintain their current accommodative stance, or will they begin tightening monetary policy sooner than expected? This is a key consideration for investors, as the central bank's decisions can significantly impact market dynamics. The experts' consensus? However, the path to achieving the Fed's 2% target remains uncertain. It's a game of wait and see as we navigate these complex economic landscapes. Market sentiment is divided as investors weigh the prospects of rate cuts against strong economic indicators, including robust job growth and steady wage growth. This divide is palpable, as some anticipate a bullish market driven by a resilient economy, while others foresee a potential downturn fueled by inflation fears. As we delve into the specifics, we find that the anticipated 3.4% headline inflation rate is causing a ripple effect across various sectors. The financial markets, in particular, are bracing themselves for potential turbulence. Investors are meticulously analyzing their portfolios, making strategic shifts towards inflation-resistant assets like commodities and real estate. Simultaneously, the bond market is also on high alert. With inflation on the rise, bond yields could see an uptick, leading to higher borrowing costs for corporations and potentially dampening investor sentiment. In this climate of uncertainty, one thing is clear: the market is acutely sensitive to inflationary pressures. The question now is, how will these factors influence market volatility and investor confidence? The Federal Reserve faces a challenging dilemma as it navigates between inflation concerns and economic stability. This institution, the backbone of our economy, is tasked with the Herculean job of managing inflation while ensuring the ship of economic prosperity sails smoothly. You see, the Fed has a dual mandate: to maintain price stability and sustain maximum employment. But with the specter of inflation looming and the economy showing signs of robust growth, the balancing act becomes all the more delicate. Hints of a rate cut have been swirling around, a move that would traditionally cool down inflation. Yet, it's not as straightforward as it seems. Recent data, including strong job growth and steady wage increases, suggest a more nuanced approach may be needed. The risk? Acting too hastily could stifle economic growth, while moving too slowly could let inflation run rampant. It's a tightrope walk of monetary policy. Despite hints of a rate cut, recent data suggests a more cautious approach may be warranted. As we await the inflation report and monitor market developments, stay tuned for expert analysis and insights to guide your investment decisions. The anticipated headline inflation rate of 3.4%, as revealed by March's Consumer Price Index, could have significant implications for the Federal Reserve and its interest rate decisions. Economists are predicting a slight moderation in core inflation, yet the journey to the Fed's 2% target remains unpredictable. Market sentiment is in a state of flux, torn between the prospects of rate cuts and the strength of economic indicators. The Federal Reserve finds itself in a tricky situation, trying to strike a balance between inflation concerns and economic stability. So as we navigate these uncertain waters together, remember that knowledge is power. Staying informed is the key to making sound investment decisions. Subscribe now for all the latest updates on crypto and stock markets. Let's continue to decode the complexities of the financial world together.